Welcome back traders to another exciting episode of our channel. In today's video, we're diving deep into the captivating world of Candlestick Mastery. Get ready to unlock the secrets of predicting market reversals with precision. Whether you're a seasoned trader or just starting your journey, understanding candlestick patterns is essential for spotting potential trend shifts and making informed trading decisions. In this comprehensive guide, we'll take you step by step through the most powerful candlestick patterns and teach you how to harness their predictive potential. Steve Nison, your guide on this enlightening journey, with years of experience in the financial markets, have honed his skills in analyzing candlestick patterns to identify high-probability opportunities. In this video, he is sharing his insights and techniques to help you achieve mastery in this crucial aspect of trading. From classic patterns like doji, hammer, and engulfing to more complex formations, such as evening star and hanging man, we'll demystify each one and equip you with the tools to anticipate market reversals like never before. But that's not all. We'll also explore advanced strategies, combining multiple candlestick patterns to validate our predictions and optimize our trading decisions. Get ready to witness the precision and accuracy of candlestick mastery. Our goal is to empower you with the knowledge and skills to confidently navigate the ever-changing financial landscape and stay ahead of the competition. So, whether you're a swing trader, day trader, or long-term investor, this video is packed with invaluable insights that will elevate your trading game to new heights. Stay tuned as we delve into the fascinating world of candlestick patterns and discover how to predict market reversals with precision. Are you ready? Let's dive in and unlock the secrets of candlestick mastery together. Forex Central, where traders become masters.
Indicators, the more the better, can also mean Eastern and Western technical techniques. Okay, by the way, this is what happens when first cousins intermarry. This is an article, cover story, Active Trader magazine did about me a few years ago. And they actually asked me to write an article, but I didn't have time, so it's a lot easier to do an interview. So they came up with the title, which is, I'm really glad because I talked about the importance of Western technicals. And so that's why the title is Helping East Meets West. And this is something we've touched on before, this combination of candlesticks and Western indicators. And people may not be aware of this. You know, I mentioned this in my seminars, but a lot more people have read my books than have attended my seminars. So a lot of people aren't aware that although I revealed candlesticks to the West in the 1980s, I've been using Western technicals since 1974. So I have over 30 years experience with Western technicals. And I use a combination of, I'm just as familiar with Western technicals. I've done whole seminars for institutions on Western technicals, in addition to candles. It's funny, speaking of that, I did a seminar, Morgan Stanley, this was years ago, before the merger. And I did a lot of stuff for their educational department. You know, they'd have their prop traders or their, actually I did some neat seminars for their quants also. And so they wanted me to do a seminar on Western technicals and a second seminar on candlesticks. Then they found out that the first seminar was going to be on Western technicals. Then they found out that they were going to have a trading challenge after my first seminar. I was just one of some in-house speakers. So the head of the training department, who already knew about my seminar, said, okay, they're actually going to be trading after your first seminar. Let's switch it around. Let's do candles first and the Western technicals after. So I found that interesting. But it's that combination of candles and Western technicals that's really important. So with that in mind, we're going to look at the candlestick screener. What the heck is that? We'll see. Change of polarity. Some of you may be familiar with this. These are some of my favorite Western charting techniques. Crack and snap. And these are, you could use these in Forex and non-Forex also. Falling off the roof. Price targets. We'll go through this step by step, so don't worry about hold off on any questions. Oscillators, we'll touch a little bit on that. Bollinger Bands, which I really like. Fibonacci retracements. Okay, this is more in the FX market. Okay, the equity seminars I do, not many people, not nearly as high a percentage as in the FX market. It's very popular. Okay, and record sessions. Okay, this is something that works really well. This is a candlestick technique that works really well to gauge if the market's overbought or oversold. So let's start with a confluence of candles. Here we looked at this a little bit before, a combination of if we have more than one candlestick line confirming another. So here we have a hammer and a bullish engulfing pattern confirming the hammer. But it's this combination of east and west. So the market if this was a bar chart, wouldn't we have this, the market's going from a downtrend to the same support area to higher lows? So just as you would draw a trend line on a bar chart, you draw the trend lines on a candlestick chart. You can draw the angle of descent. So on the left side, the market made lower lows and the same lows, stabilizing, and then higher lows.
Usually when it's a bearish market, I used to use the higher highs points to draw the line.
Okay.
The lows.
Right. What I'm showing, what Young's saying is, when a bearish market, he's connecting the highs. Yes, to make a falling resistance line, you draw the higher highs. What I'm showing here is just showing the market's making lower lows. So we're going from the market's going from lower lows to what's happening to the lows. It's kind of stabilizing, right, and then higher lows. Now, keep in mind, most of the trend lines you saw today, and we'll see later on, are horizontal support and resistance lines. I don't place much emphasis on angled trend lines. Now, Young was mentioning like a falling resistance line. I will look at that, but I don't place much, as I mentioned, I don't place much importance on them, because I can give 10 people a chart and I can ask them to draw angled trend lines. I'll get 10 different answers. If you ask me to draw horizontal, where are the major highs and major lows, and draw horizontal support and horizontal resistance, we're all going to be looking at the same thing. So that's why I really emphasize horizontal support and resistance. Examine how the market acts at support or resistance. And the reason for that is because we want to get ways of getting the probability on our side. Okay. What we're doing today is using the candlesticks, and I'm showing now to combine candles with Western technicals to help get the odds more in our favor. Okay, the better the odds are, the more successful we'll be. And speaking of better odds and more successful, look how flush I am, right? Now, how do we get those higher probability trades? By using what I call my candlestick screener. And what this is we're going to use candlesticks at support or resistance to screen for the best probability trades. So we're going to be looking for horizontal support or resistance. We could use trend line, angle trend lines, it's less important, but specifically horizontal support or resistance, and then seeing if the candlesticks are giving us any signals that the prior trend is losing momentum. Is the market at resistance? Yes. Well, let's say would we say it broke resistance? No. I mean, it's above the lower band of resistance, but if we think it broke resistance, would you want to buy on that? No. Okay, so it did not break the resistance. It broke the bottom end of resistance band. It didn't break the resistance. But are there any reversal signals yet? Okay. There's a lot of the literature I had translated related a lot to trading. It's like going into battle. So the Japanese use a lot of samurai sayings, military analogies. And one samurai saying is, do not attack crack troops. Okay. Would we attack from the short side here? Should we be attacking from the short side? No. All right. Okay. They also say look for vulnerabilities in your opponent. Okay. Okay. Any vulnerabilities now?
Yeah.
Okay. So here we could think about initiating a short position, because the candlestick screener, the two things you're asked is the market at support or resistance? Notice how I used resistance area here. And are there any signs the market's losing momentum? There's no way I would even think about selling here, or maybe lightening up a little bit on longs, but ever so marginally. It's this candlestick signal that shows us the force of the market, the force of the bulls are losing steam. If this happens to be a Harami, I don't know if it's quite a shooting star. If this did not confirm resistance, there's no way I'd be thinking about selling short. Okay? But because it's confirming a resistance area, I would think about selling short there. Yes, sure.
when you say about the resistance and support, I use based on the e-signals or daily chart previous day, high and low and pivot points. But now, what I confuse is when I look at the candlestick, I have to constantly review the charts based on the various signal. So.
Okay, the question, how I come up with support and resistance?
Yes.
I will look at highs and lows like this, okay? Or I would also look at the candlestick signals. For example, here we have a bearish engulfing pattern on the left there, okay? But the main thing is we had a series of highs right around the same resistance area. Okay, but even if you didn't have this, even if we had the bearish engulfing pattern, and then we had that tall white candle in at the bearish engulfing pattern's resistance,
Yes.
all right? If there was no turning signals, I would still not want to sell short. It's a small wheel body. However you define resistance, okay, I'll define it this way or with a candlestick signal. However you define resistance, if there's no sign that the prior trend is losing steam, I would not think about initiating a position.
Okay, thank you.
Okay, and this is, so is the market at resistance? Yes. Are there any reversal signals yet? Now there are. Yes.
So here, even though you see a reversal candle, it still didn't touch. See, in this case, the resistance zone is like very narrow.
Mm-hmm.
So you still wait. I'm seeing sometimes, many times it happens is, okay, you say a reversal candle, you go short, but it might just go back and spike you up.
Right. The question is, you see, it's over here. Do you just wait? Because what could happen is the market could go up and spike you out. Right. It could happen. But you don't know. To me, this is confirming a resistance area. And if it spikes out especially on the close, if you're short, you're wrong. And this is fine for a risk reward, right? Even if you're looking at the recent lows, those lower shadows, okay, my more important support area would be this little piercing pattern in March. But even if you're looking at those lower shadows right around 117.25, this is a fine risk reward. Okay, and this is what happened after. Okay. Although the market is at resistance on that tall white candle, and the resistance area here, we know the market's at resistance. Go back here. Okay. The market is at a resistance area. The analogy I like to make is we know there's resistance there, but we're not going to sell because we don't see the market slowing down. Just as the case would be is if we're crossing the street, we have the light in our favor. We know we have the light in our favor, but wouldn't we wait for the car to slow down before crossing? You know, yes, you're right. You know, you have the light, but if you run down, big deal. You're right, but you're dead. So think of the candlestick signals as giving us a warning that the car is slowing down, the momentum is slowing down. That's what the candlestick screener is all about. You're looking at the market at support or resistance and then screening for candlestick signals to see if that trend is running out of steam. And here again, I'm not real big on trend lines, but just to give you a sense for those who do use angle trend lines. Okay, you can see how we had some upper shadows, small wheel bodies at the resistance area. Question? Okay. Yes. Oh, on the March lows.
It's going to be in February.
February. Didn't the market close under the bullish engulfing pattern? Once the bullish engulfing pattern is done, you don't use that as support anymore. Right. I mean, that's not a support area anymore. Okay. Right. Once the market breaks support, once the market broke under support in late February, I don't look at that as a prior support area. Okay. Now, also, in this red circle here, see how the market's having some problems right near resistance area? And although it's making mainly higher highs, it's really struggling with those upper shadows, small real bodies, a couple of lower shadows, but mainly the small real bodies. And actually, the Japanese would say if a market's rising with small real bodies or doji, they'll say it's a market rising in agony. Okay, it's moving up, but it's really, really struggling. And here we had the black candle wrapping around how many white real bodies? God, right. And this brings us to differences between using candles to exit and enter a position. Okay, if we have like for example here, a candlestick signal confirming a Western signal, we could use that to enter a position. But if you have a candlestick signal that's not confirming a Western signal, I would use that to offset a position. And exiting is very, very important. I had this cartoon made up. You know, not many books written about, not much material written about exiting. And what you could do, in fact, what my friend Ken Calhoun, I don't know how many of you trade stocks, but Ken Calhoun and I have done some joint DVDs. He's president of Day Trading University, and he actually uses 1- and 2-minute intraday setups. He'll look at time and sales, he'll look at breakout plays, and he doesn't use candles to enter a position. What he will look at is initiate the trades, and this is actually on one of our joint DVDs. He will use candles to exit a position. So he'll buy, for example, on a breakout on a 1- or 2-minute chart, and he'll stay in the position until he has 2 or 3 opposing candles or until he gets a bearish candlestick signal. There's nothing wrong with that. If you enter a trade for some other reason, not related to candles, and you see a candlestick signal, for example, a doji that's not confirming something else, nothing wrong with taking profits using candles to exit. So here we have a hammer near a support area. Because that hammer is confirming support, I would use that to initiate long positions. This is the major difference. A candle signal that confirms something else, that confluence, the more indicators the better, that's when we use the candles to initiate a new position. When do we use a candle signal to exit a position? If it doesn't confirm something else. So for example, I would use this doji to exit a position. Now, I don't know if it's confirming resistance or not. How would I know if it's confirming resistance? What would I have to do? You have to go back, right? But assuming it's not a confirming resistance area, I would use that doji to exit a long position. If the doji was confirming resistance, I would use that same doji to initiate a new short sale, if the risk reward is good. Can the doji still mean it can go in an uptrend? And the answer is yes, because the doji, all it does is turn the trend from up to neutral. It doesn't turn it from up to down. And in fact, one of the reasons you always have to use stops is, say the market moves up. Let's say the market is overextended here, overbought. Now, as the market, it didn't happen to trade sideways here, but if the market traded sideways for a long period of time, isn't the market relieving its overbought condition? Yes. That, in a sense, is making the market healthier. So how do we know that the market's going to break out above the doji? You have to wait for the market to break out above the doji. That's how you know. Right? No. Well, with this doji, I would use this doji to lighten up on longs. I would not be selling short on this doji. I would take profits, lighten up on longs. Oh, I would definitely lighten up. Yeah, I would lighten up on longs. Move up stops.
Steve, this is a place where you would, in that case, where the doji started, the neutrality zone, let's call it, and traded sideways. In terms of Western technicals, you have a tight bull flag, which is a strong continuation indicator.
The question is, we have a bull flag. Where's the bull flag?
The question really is, where you're saying it would be, the doji is a sign of neutrality.
Mm-hmm.
And instead of turning around, the market's working off its overbought condition.
Right. Only if it trades sideways for a while.
It's going to trade sideways.
Right.
And in terms of not looking at the candlestick in terms of the Western, now you're talking about a bull flag.
Okay. What he's saying is the market moves up, and let's say we have a doji or some spinning tops, and the market trades sideways. Don't we have a bull flag? And the answer is no. When do you have a bull flag confirmed? When it breaks out of the top end. That's the if-then. If the market closes above the resistance area, then you could use the measuring for the bull flag. All you're doing, it's not a bull, it's like a double bottom. If you have two lows, it's not a double bottom. When is the double bottom? When it takes out the intervening high. When do you have a head and shoulders break? When you break the neckline. Okay? So it's a potential bull flag, but it's not a bull flag until the market breaks out of that sideways, or if it's a pennant and breaks out of the triangle. Okay, so here we have a bullish engulfing pattern based on the bullish engulfing pattern. what would be our target? So we're over here. Okay. That's a great risk reward. Okay. Now, we'll look at adapting to the market later, but as time progresses, so that's our target up there on the red horizontal lines. But as time moves on, see what market formed? We have a doji, also a harami, right? Small real body and a big real body. Nothing wrong at that point with moving up stops. You may want to take some profits also, but nothing says you have to stay 100% long until we reach our target. Okay? So I would use that doji and the harami as a time to adjust stops.
Where would you move them?
At a minimum to whatever the risk is. Whatever my risk was, I would do that to break even, so you're not playing, with that risk again. Okay. The change of polarity. We're looking at candles and Western technicals. So change of polarity. Okay, I came up with the term, but it's a very basic Western technical technique. What happens is old support becomes new resistance. Let me explain why. The market is holding support here. Let's say that yellow dotted line is the euro 123. And it gets down there, it bounces, it gets down there, it bounces, and every time it bounces, traders who missed buying it are upset. Okay, so they buy it on this session here, and you bought at support. Congratulations, you bought at support, right? So this is where religion comes back to Wall Street or to the Forex trading world, because you say, please God, let me break even, and I'll never do this again. And you have dreams like this, okay?
Oh, yes, I did it.
Right? Right?
I admit that.
Right. So what happens essentially is the buyers, once it breaks support, the buyers, once the market breaks even, become what? Sellers, right, because they're thrilled. I mean, it's human nature. You're underwater, you're thrilled to break even. So old support, and this is just one of many reasons why the psychology of technicals works. So old support should become resistance, old resistance becomes support, because people are upset they missed the breakout initially. This is one of my favorite Western charting techniques, works well in all markets, all time frames. In fact, when I used to work at Hutton, when I used to actually follow bond futures, and go back far enough, early 80s, there were Ginnie Mae futures that were so popular. And I used to look at what we back then called tick charts, which was different than what tick charts are now. But essentially, every trade was and it was just a line chart. And I use this technique all the time, just on line charts, tick by tick by tick. Works great in any time frame. So let's look at some examples. And it has to be a support zone tested at least 2 or 3 times, not just one support level, not just a bounce. So here we have a multi-tested support area. Old support should become new resistance. Okay. Some of you may have also heard of an internal trend line. I'm not real big on this, but just in case you come across reference, essentially it's just an angled trend line. And once the market breaks under it, the old support becomes resistance. I'm not crazy about this. I just really like horizontal support and resistance. But just in case you ever come across that expression, an internal trend line is an angled trend line. So here we have, see how old support became resistance. And what was extra ominous, and when I say extra ominous, it doesn't mean the market's going to fall further. It just means the odds of the market turning are higher. Is obviously we had a doji. And that would be a short sale for me because the doji is confirming a resistance area. And what happened on the session after the doji to give us extra confirmation? What 3 candle lines before the candle line before the doji and after the doji? What 3 candle lines? What pattern did that form? Mm-hmm. Evening star, right? Even if it's a doji, it's an evening star. What we're going to look at now is one of my favorite indicators is if a market breaks a support area and can't hold it, it's very bullish. Or if the market breaks resistance and can't hold the new highs, it's very bearish. So let me go through this. The first one is the crack and snap. The market cracks under a support level, which should be tested 2 or 3 times. Cracks under it, and then snaps back above the previously broken support level. We could use that to buy. And what you should do is, this you could use an intraday stop. If the market indeed is solid, those lows, those intraday lows, should not be pierced. So you can keep a stop under the low, and your target is the most recent high. In equities, I like to see this confirmed by volume. So if the market breaks support, I like to see it break support on light volume, and when it springs back, the volume increase. But in the Forex, this is fine just the way it is. The reason something like this works, and the reason this works, and I'll go through it, the rationale behind it in a couple of minutes, the falling off the roof, it's the opposite of the crack and snap. The falling off the roof, the market has a very clean-cut resistance area. The bulls push above the resistance area, and then it pulls back under the resistance. Great short sale if the risk-reward is good. Of course, your risk is to the high of the move, and your target is the most recent low, the pivot low. Now, the reason crack and snap and falling off the roof, and the reason I call this falling off the roof, by the way, is because there's a Japanese proverb that says, let him climb the roof and then take away the ladder. Okay, so this is this poor guy on the roof, and you're pulling away the ladder. It's a false breakout. And the reason for these work is because, especially if it's tested, and it should be tested many times, is, do you think the stops are obvious? Right? And what are the big players going to do? Either if the market's at a very obvious support area or a very obvious resistance area, they know where the stops are. What are they going to do? They're going to gun for the stops. The market will push through the resistance, and those who pushed it up there, who are gunning for the stops, what are they going to do? Hang around? They're going to sell into it. Okay. Same thing with a crack and snap. Near a support area, if it's tested many times, they know, they being the large players, the interbank, the interbank traders, they know where the stops are. They're going to gun for them. So let's look at an example here. Here we have a bullish engulfing pattern, but it doesn't matter. Even if we don't have a candlestick signal confirming it, as soon as the market breaks under the support level and cannot hold the new lows, we can think about buying it. And in this case, the target would be the most recent high, the pivot high. Yes? No, it does. It could be. The question is, do I use a rule? How far under? It doesn't matter. And in this instance, you see how it moved under it intraday. Even if it closes under it, as long as it gets back above it within 3 sessions, you can use that technique. Now, obviously, if the market breaks under it by a lot and your target is not too high, it's not going to be a good risk reward. But there's no minimum amount. Okay, here we have a falling off the roof. See how the market poked its head above resistance and couldn't hold above it. So what's nice about this is that we have a target, which is the most recent low. And this is one important aspect about the Western technicals. Okay, we use Western technicals to get price targets, whether it's immediately preceding low. This is actually a Western charting technique derived by an equity trader in the 1920s, believe it or not. Because one of the things we have to be aware of is that candlesticks do not give price targets. They're great for reversals. That's what we use the candlesticks for. We don't use them to get price targets. Don't make candles into something they're not designed to do. The Japanese say, don't climb a tree to look for a fish. Okay? We use the candles for the reversals. we use Western technicals for the price targets. So the candlesticks, as shown by this cartoon, will show us the trend. It doesn't show us how far it's going to go. Okay? So we know the direction could be changing, but we just don't know how far it's going to go. And this is why we need to combine Western technicals with candlesticks. Okay. Okay. Here we have the doji confirming a resistance area. Yes?
In a situation like this, immediately after the doji has closed, you would feel confident buying on the open of the next candlestick?
You mean selling?
I'm sorry.
Selling, yeah.
And then you could just stop above the doji?
The question is, on the opening of the next candle, which is nothing wrong to do if you want to confirm the doji. You're waiting for the opening, because the doji is actually confirmed on the close. But if you want to wait for the opening on the next session, that's fine. The question is, would we sell on the opening of that candle? We don't know it's going to be a black candle, and I'm going to throw it open to you. I'll ask you, would you be comfortable selling on the opening of that right after the doji? Yeah. Okay. And why?
I would sell because in my mind that's enough confirmation. We have the resistance.
Right.
We have doji confirming the resistance, and you have the bullish candle before, and isn't that a shooting star also?
The
doji.
okay.
I don't know. I think in my mind
What? Okay. She's saying yes. The doji is confirming resistance area, which is fine. That's one thing we should be asking. What else should you be asking?
Risk reward.
What's the risk reward?
it's a small. Well, we don't know the market.
We do know the risk reward on that.
We know already.
Yeah.
Oh,
I would.
previous support.
Yeah, I would think this would be an okay risk reward trade. Right. Right. So we're using the prior lows as our target. Do we get our target based on the candlesticks? No. Okay. We're getting it because it was a support area. We're getting the reversal based on the candles, the doji confirming a resistance area. Also, the doji confirming the resistance area is another reason we're using Western technicals. Nothing more basic on Western technicals than resistance. So we have the doji confirming resistance area, and we're using the Western technicals for the price target. However we use measured moves, somebody had mentioned the bull flag before. Any patterns you use on the bar chart, obviously you can use on the candlestick chart. So for example, here we had one change of polarity, how the market broke above resistance area, and it became support, didn't quite get down to that level again, but old resistance became support, and the market was in a boxed range. If you remember what I said before, how do we get a measured move with a boxed range or a lateral trading environment? What do we do? Right, measure the height of the range, and whichever way the market breaks out, you add that. So you'd have, and I'd be conservative. I'd go to the top red line rather than the bottom one, and this would be my target, conservative target. Doesn't mean the market's going to stop there, but the point is, whatever you use for patterns on a bar chart, use them with a candlestick chart. Yes.
You still wait, like in your case, follow proof scenario. See, once it breaks the resistance, you wait to see if it tests before it goes up.
Okay, the question is, once the market breaks resistance, do we wait to see if it tests the support before buying? Right, because the problem could be if it gets above the resistance area and can't hold above it. Right. The way we look at it is that once the market has a tall white candle there, we're bullish. The market broke above resistance, we're bullish. What price says we're wrong? If it closes under old resistance becoming new support. But on a tall white candle like that, I would be bullish. And I would be buying it and keep a stop under the old resistance becoming new support.
In this case, it is trying to even test it, right?
It came down to a couple of sessions later.
But in the intraday, you just
If you're looking at it in intraday, you may find some reversal signals down there. Yes?
And your target is the width of the range?
The target is the width of the range, right? And I would use that to take some profits. I would never, ever initiate a new position based on a target. I would never go short just because it reached a target. If you get a bearish candlestick signal at a target, then we can think about it. And just an example here. Here's normally an ascending triangle normally happens during a rally, but doesn't always need to be that way. An ascending triangle is the market is trading horizontally, you have higher lows. And when is an ascending triangle confirmed? How do you know when is it an ascending triangle? When the market breaks out of it. Okay, it's building one, but it's not confirmed until the market closes above it. And you could just take your measured move from the ascending triangle. Okay. Again, box range is one of my favorite measuring techniques. Okay, so in other words, here the market broke under the support level. By the way, as soon as it broke support, what became resistance? That's what. So this is getting back to Sharish's did I pronounce it? Question. You know, he was talking about a resistance level. When it breaks resistance, do you wait for a pullback? I said no. If it breaks a resistance area, we would be buying it. The price we'd say we're wrong is if it comes back below the support area. Same thing here. As soon as the market closed below the support area, short, the price, there's always a price that says I'm wrong. The price that says I'm wrong is old support should become resistance. If the market closes above that, we're wrong. And actually, more than wrong, because it would be one of those crack and snaps. That would actually be bullish. But I would be short on that with a stop-out level above that horizontal line, the bottom red line. And what we do is we take the height of the range as a potential target. Yes?
So Steve, on this pattern, if you had gotten a failure on the downside of it, cracked, went back up.
Right. The question is if we had a failure and it moved back up.
Would you reverse the trade and go long?
Okay. The question is, would we reverse the trade and go long? If you have enough psychological wherewithal to say, I'm short, I'm wrong, I'm going to go long, yes. So we're continuing now with head and shoulder, Western technicals. Here we have head and shoulders. So once the market breaks under the neckline, it becomes a potential sell signal. So once the neckline is broken, it's a bearish signal. And by the way, in Japan, the head and shoulders is called the three Buddha pattern. And that's because in Buddhist temples, you have a large central Buddha. And on either side, you have two smaller Buddhas or saints. And this was around in the 1700s in Japan. And the head and shoulders was around in the 1920s in the US. And just shows how universal and timeless emotions are. And that's what technicals measure. Okay? Fear, greed, hope. There's a wonderful quote I had, and this is just, not from a Japanese source, but just to show you the universality and the timelessness of emotions. The world is too big for us. There's too much going on, too many crimes, too much violence and excitement. Okay, try as you will, you'll get behind in the race in spite of yourself. It's incessant strain. You try to keep pace and you lose ground. Science and all those discoveries move on you so fast that you stagger beneath them in hopeless bewilderment. The political world seems so rapidly changing that you're out of breath trying to keep up with it. Everything is high pressure. Human nature cannot endure much more. This was written in 1833. Has anything changed? Isn't that amazing? So human nature, timeless, and this is why we have the same pattern emerge in Japan as in the West, because technicals gauge the emotionalism of the market. Fear, greed, hope, they're all reflected in the charts. So here we happen to have an inverted head and shoulders, and I want to show you these because it shows how you can use Western technicals on a candlestick chart for measurements. This one, that measurement, I probably would be totally out of long positions on that measured move. Why? It may be a little hard to see on the screen, maybe a little easier in your handout. What did we get at the measured move? Okay, so the measured move is the blue vertical line. It looks like an April. The opposite of the piercing, the dark cloud cover, right. I wouldn't go short, okay, because it's not really confirming resistance, but I certainly would take profits. Okay, here we have a bear flag. which was confirmed when the market broke, or bear pennant. Now, this is interesting. Here, like in the prior slide, we have the dark cloud cover confirming a target. And here, the same thing. We had a target with a bear flag. Essentially, what you do is to take the height of what's called the flagpole, and you take that from the bottom end of the trading range of the pennant. This is actually a bear pennant. If it's triangular, it's called a pennant. And if it's like a parallelogram or rectangle, it's called a flag. And the target is shown by the blue dashed line. And right at the target, in that red square, what I've done is I'm going to blow up that red square because it's a little hard to see. But in that red square is a piercing pattern. You see that vertical blue line is showing us where the target is. I just expanded. So what I've done is I've expanded this red square into this to show you the piercing pattern. Okay. Why would you, in spite of the piercing pattern, I would definitely consider taking profits there. Why would you not be going long? Think about the change of polarity. Right, the change of polarity. See how it broke under a support area? Old support should become new resistance. Once it got above that old resistance, you actually had a crack and snap. I don't know if it ultimately got to the top end of the range, but. Oscillators. Okay, this is really not an intense course on Western technicals, but I know many of you use oscillators, so I wanted to make sure I touch on it. And an oscillator is mathematically derived and includes RSI, stochastics, and so forth. And it's very objective. Okay, there are specific numbers. They were mathematically derived, so there's no room for subjectivity as far as the numbers are concerned. How you interpret oscillators, there is some subjectivity. Okay, separate from the price action. So for those new to oscillators, you're going to have the price on the top and the oscillator on the bottom. And oscillators really should, most people don't remember this, but oscillators really should be used in lateral markets. You should not have strongly trending markets. We'll look at an example of this in a couple of minutes. People forget about that. And includes these oscillators, stochastics, RSI, the MACD. The etc. oscillator is very rare. How many use oscillators here? Okay. This will be interesting. How many use RSI? Okay. Stochastics? Okay. Both of them? Wrong. You shouldn't. You should not use the same. You should use one oscillator because you're going to totally confuse yourself. You should be using, when you're trading, again, this is a different course than what I'm teaching here, but when you're trading, you should be using independent information, right, for lack of a better word. You should be not using 2 or 3 oscillators. You should be using something that follows price action, an oscillator, and then something not related to an oscillator, maybe a moving average. But you shouldn't be using 2 of the same thing because you're totally going to get confused. The RSI is going to show you one thing, and the MACD is going to show you another. If you really want to use an oscillator, which is fine, pick one that you're really comfortable with. Don't do 2 or 3 or 4 because they're not giving you any more information, and in fact, it's going to confuse you. Bollinger Bands would be another add-on also. Yes, it depends on the time frame. You may want to, right, okay, so that's a point. Shirish mentioned it could be different time frames. So if you're using RSI in one time frame and stochastics in another one, that's fine. But don't use RSI and stochastics in the same time frame, or the MACD. Now keep in mind, oscillators, they're good, but they're lagging indicators. All right? But let me show you the main uses, the way we're going to talk about them, since so many traders will use them, is gauging if the market is overbought. Essentially, an oscillator, no matter which one you're looking at, is gauging the momentum of the move. So has the market moved up too far, too fast? And another major way is divergence. So let's look at using oscillators with candlesticks to increase the probability of the candlestick signal working out. Remember I don't remember which chart we looked at, but we said one way to increase the likelihood of a candlestick signal calling reversal is if the market is overbought or oversold. We could use oscillators to gauge overbought, oversold. So this happens to be RSI, and usually what is it, 70, 80%. the market is viewed as overbought. So with this first doji on the left with the green arrow, is the market overextended based on the RSI? Yes. Therefore, I would probably, this is not enough reason to go short on the doji, assuming it's not confirming resistance. But it does increase the likelihood of a sell-off. Now, look at the other doji. Now, is the market overextended? No. And this is one way, one of the challenges we may have with is, for example, a hammer in a downtrend or not. What you could do is kind of a way around that is look at the hammer and look if the market's oversold. Right? And if the market's oversold and we have a bullish hammer, the odds of a turn are much higher. So the second doji here, although it may not be too much of a box range, the three candles before looked like kind of a box range. But ignoring that, we could look at the oscillator and say, okay, the market's not really overextended. I'm not going to pay too much attention to this doji. So that's overbought, oversold. Divergence. Okay, just very quickly for those a little bit new to oscillators, divergence is bullish and bearish divergence. Bullish divergence is when the price makes a new low. Now remember, the oscillator is separate. It's on the bottom of this chart. At the time the price makes a new low, the oscillator does not make a new low. That's called bullish or positive divergence. Many, many traders will use this. Negative divergence is when the price makes a new high for the move, and the oscillator does not confirm it. See, because the oscillator measures momentum, we want to see the momentum in line with the price action. So if the market's making a new high for the move, we want to see the momentum making a new high for the move. If you get divergence here, it's a sign that the market is vulnerable. So here on the RSI, see how the hammer made a new low for the move. What happened with the oscillator? Did it make a new low for the move? No. Once again, I would never use oscillators by themselves. The Japanese say the thunder is loud, but there's little rain. Okay? The oscillator is a potential setup, but how do we know that the market's going to turn? The odds of the turn is by using the candlesticks. That, to me, is the final filter. Use the Western technicals to give you the alerts, the oscillators, the support and resistance, but the real trigger, the real confirmation comes with the candlesticks. What else is also positive about this hammer? And I don't expect you to pick it up easily, but look at the support level. The prior support. Yeah, one of those kick things. Yeah, cracking, whatever you, it doesn't matter what you call it, as long as you know what it is. I don't care if doesn't matter the name. You call it the water fountain. I don't care, as long as you understand the concept. The market broke under the support. What happened? Couldn't hold it. What's your target? Can you see the number? What would be your target on that crack and snap? The most recent high, right, which is about 20, which is this? This is the pound. Oh, this is actually the pound yen. So it would be, yeah, right up there. That would be the target. Okay. And what's the stop? Intraday, the lower the hammer. In this case, because it's a crack and snap intraday. Why would you be looking at this hammer here, but even before the hammer, the market's gave you another potential buy signal. And what was that before this hammer? Long shadows. What else? Long shadows is certainly plus. Harami, and what else? Hammer. It's a hammer. Yeah, another hammer. The low of the hammer is a support level. Double bottom. But the low of the hammer is support area based on the close. But all your answers are correct. Long lower shadows, the Harami pattern. So, okay, for those who use stochastics, Essentially, for those new to stochastics, you have two lines. You have a percent K and a percent D. Percent K is faster line. If the percent K crosses above the percent D, it's a positive signal. Yes. Was there a question? Okay, so on slide 133, what are you asking about the bullish engulfing pattern?
Bullish engulfing pattern before the doji.
Oh, over here? What he's saying is the bullish engulfing pattern here that I'm circling. This looks like an okay risk reward. If you buy here, what's your target? I would probably say up here. And, we got here. We'll look at intraday later. You may have gotten a negative signal there on the intraday chart to tell you to get out. Remember, resistance and support is not to the tick. And one of the things we're going to look at is, hey, is this a failure at resistance? You may have had a bearish engulfing pattern on the hourly chart there. And I would say in that case, that's close enough for my target to get out. We're going to look at some really cool things with intraday. Okay, so here we have a couple of signals here. The blue arrow, the first one, points to a doji. This is actually called a dragonfly doji, where the opening, the high, and the close are all in the highs of the session. It's really a hammer, but instead of a real body, it has a doji. But what are the stochastics showing us? Is there a positive crossover? Is the market oversold? No. With the bullish engulfing pattern, is the market oversold based on the stochastics? Yeah, it's below 20, 25%. And we then had positive crossover. So the idea is if you're using stochastics and you're really comfortable with it and you know all the nuances, and I certainly don't, okay, there are whole books written on stochastics, stay with it and just use the candles as that final confirmation. But you could also go kind of the other way by, if you're getting a candlestick signal, make sure if you're really keen on RSI that the RSI is confirming what you're seeing with the candles. Let both reinforce the other. Okay, bearish engulfing pattern, negative divergence. Okay, this, yes?
Sometimes when you see the divergences.
I'm sorry, the question is sometimes when you see what?
Sometimes you see the divergences, but the price will still keep going and making more than one divergence.
Okay.
So many times you get caught, and then you get stopped out, and then you see next divergence, you get stopped.
Okay, the question is when you see a divergence, sometimes the market will have a divergence and keep on going up or down. This is exactly what happened in the 1990s with the good old days in the bull market in stocks. I cannot tell you how many technical analysts I was saying the market's going to top out, we have negative divergence. This is why it's so important to use the candlesticks. Negative divergence is your alert. What's the raindrops? What's the final confirmation? The candles. Okay. So just because I see negative divergence doesn't give enough of a reason to initiate a trade. If I get a candlestick signal, also very important, and it leads nicely into the next slide, is make sure the market is not trending, because what's going to happen is if you have a strongly trending market, so this is the RSI, and notice how the RSI on the left side of the slide remained overbought, because the market was trending. A really good measurement of trending is ADX. How many here use the ADX line? Okay, if you don't, you really should think about using it to see if the market's trending. Essentially, in the ADX, I'm not going to get into the math about it, but the ADX line measures how much the market's trending. It doesn't matter if the trend is up or down. If the ADX line is ascending and is above, I'd say, 25 or 30%, the market's trending. So you could have a rising ADX line as the market is trending down. That rising ADX line just means the trend is more entrenched than you would have if the ADX line is flat or descending. So notice on the left side, the ADX line is ascending, very high, very strong trending market. You ignore oscillators, because what's going to happen, it's going to be pinned in the overbought condition and stay there. And notice how the ADX line at the red arrow here is moving down, is still moving down. I shouldn't say is still moving down, is now downward sloping. It's very low. It's under 25, 20%. What is that telling us about the trend of the market? Is it trending on this red vertical line? Is it trending anymore? Not. It's flat. Now you could use the oscillators. So for those not familiar with the ADX, read about it. It's available in all the charting packages, but it's a really good way of measuring if the market is trending or not, because oscillators really should not be used in trending markets. Now, one of my favorite Western indicators, and this is perfectly fine to use with oscillators, Bollinger Bands. Bollinger Band is, for those not familiar, the default is a 20-period moving average, which is fine, and then it's 2 standard deviations above and below the 20-period moving average. Essentially, it means 95% of all the price action should be defined by the top and the bottom of the Bollinger Band. And what that means is, as the market gets less volatile, what's going to happen to the bands? Shrink. As it gets more volatile, it's going to expand. So how do we use them? Another way to gauge overbought, oversold, which is separate, actually, than oscillators. Nothing wrong with adding this in addition to oscillators. So here we have a couple of negative signals here in the euro-dollar. Some doji, a bearish engulfing pattern on your right. And, well, you'll see on most of our charts, on the FOREX charts, and when I say our, in our newsletter, and also we do this on equity indexes, we'll almost always have Bollinger Bands, because they work very well as overbought or oversold indicators. So you can see how these confirm the top end of the Bollinger Band. So what this is showing us is the market is overextended. I really like Bollinger Bands. If you're not using them, you're shaking your head yes. If you're not using them, look at them. Now, if you trade individual stocks, sometimes it works and sometimes it doesn't. But if you get something like this on your individual stock, if you're trading stocks, and you see the top end is where the market stalls out, start following them, but they work really well, very well in the FOREX markets. So here we have some bearish engulfing patterns, a shooting star, an evening star, and right at the top end of the Bollinger Band. Again, on the right side, we have some doji, some long upper shadows. And we could go through these pretty quickly. Okay, a doji at the top end of the Bollinger Band, a piercing pattern at the bottom end of the Bollinger Band. John Bollinger doesn't like to think of Bollinger Bands as support or resistance. They really should be gauged as the market's kind of reaching an extreme, and that's why I like to look at them. Okay. Here we have a group of signals. We have a bearish engulfing pattern, a shooting star, negative divergence. Okay, top end of the Bollinger Band. This is what we look for. And obviously, if you think, although we have that group of indicators, that increases the likelihood of a turn, but how do we know if we're going to pull the trigger on the trade? What do we always have to think about? Risk reward. You could have 20 signals intersecting at once. This is a plethora of signals, but unless it's a good risk reward trade, you don't do it. I don't care how many signals you have. And this one looks okay. This risk, I'd have to see what the risk is. But certainly, with the pushback up to the top of the bearish engulfing pattern, we could think about it.
Do the Bollinger Bands change your support resistance lines?
Do the Bollinger Band change support and resistance lines? I'll be still looking at the support and resistance area. So, for example, we might have, let's say we're at this point here. Okay, we don't know what happened here. Okay, our first support area, I'd have to look back here. I might have change of polarity. So we'd have that as S1. Let's assume this is S2. And the bottom end of the Bollinger Band, because you can extend them, would be my S3. So it's just another way of gauging support or resistance. They don't replace them. And what you'll see a lot of times is if we have a Bollinger Band coinciding with another reason for support, the markets very often will turn. So let's say we had the Bollinger Band at a major support area, very often the markets will turn. Okay. Now, one technique used a lot in the FOREX market are Fibonacci retracements. And these are essentially, these are the major retracements, 38.2%, 50%, and 61.8%. So essentially, if the market rallies from 100 to 200, a Fibonacci 38.2% retracement would be 162. 50% is 150. To me, the most important retracement is 50%. Because there are traders who will look at just 50% retracements, even on the equity side. Okay, although not many equity traders will focus as much on Fibonacci retracements as they do on the FOREX side, a lot of people look at 50% retracements. So to me, that's the most important one. So essentially, the idea is if the market retraces certain levels, it could be a bounce area, but once again, only if confirmed by a candlestick signal. A Fibonacci retracement confirmed by a candlestick signal normally is not a reason for me to initiate a new trade. I really like looking at solid support or solid resistance for me to be comfortable recommending going long on a new candlestick signal. A Fibonacci retracement is just not that significant, like a major low or a major high. So, for example, here we have the hammer confirming a 50% retracement. Would I use that to go long? No. Would I use it to lighten up or cover shorts? Yes. Okay. If that hammer confirmed a support area, then I would use it to go long. Okay. Same thing here. We have a doji confirming a 50% retracement. I wouldn't be using that to buy. Now, let's say we had, and this is not the case here, but let's say this was a prior resistance area, right? Old resistance should be what? New support. And let's say the 50% retracement was here, or even a 61.8% retracement was here, and then we had a doji there. That would be a reason to buy. Okay? Not so much the Fibonacci, it's because it's confirming an important support area. Okay, here we have a couple of bullish engulfing patterns near 61.8% retracement. I just rounded off to 62. And I tell you, if we didn't buy in the first bullish engulfing pattern, which probably would not, would we buy in the second bullish engulfing pattern, and why, or why not? Okay, so we had two bullish engulfing patterns there. Okay, the first one, or actually the first one, sorry, is probably a piercing pattern. The first white candle didn't look like it got more than into the black real body. So the first one is a piercing pattern. And the second one, I'm assuming, it looks like the trend is still down, although we traded sideways for a couple of days, but to me the trend still looks mostly down. Why do we buy in that bullish engulfing pattern where we would not buy on that first piercing pattern? What's the difference? Didn't they both confirm the Fibonacci retracement? But what's the difference?
Because your target is not that much because you have a prior support.
Well, prior support area, that would be one thing. But the second thing is, the reason we could think about buying on the bullish engulfing pattern, this to me would be minor. This to me would be, sometimes it's hard finding the pointer. So he's saying the prior support should become resistance, which indeed is true. But where is the more important resistance area? The recent high, right. So what we could do is use that red line as a conservative target with the idea that the more important target is the recent highs. But the point I want to try to get with this is that now we have the piercing pattern confirming the Fibonacci retracement. Once we have the piercing pattern, what becomes support? The low of the piercing pattern. Did the low of the piercing pattern hold with that bullish engulfing pattern? Yes. So now we have a piercing pattern and a bullish engulfing pattern, back-to-back candlestick signals at the 61.8% retracement. But it's the back-to-back candlestick signals that really would give me the reason to buy. If I just saw a piercing pattern at the Fibonacci retracement, the Fibonacci is just not that strong a signal. But once you have the piercing pattern as support, and look how nicely that piercing pattern held as support, even after the bullish engulfing pattern. Again, just you could look at this pretty quickly. As far as the text is concerned, Fibonacci retracement, Harami. Yeah, you can do. The question is, do you use Bollinger Bands? You can use them all the time.
But many times I see when it is trending up, it's always at the upper band.
Yeah. Okay. The question is, with the Bollinger Bands, keep in mind the top end of the, especially if the market's trending or even if it's not trending that strongly, the Bollinger Bands, the top end of the Bollinger Band is going to be increasing, right? So yes, it's still, I don't want to say resistance, it's overbought. So you're going to have a correction if you get a bearish candlestick signal. But you could use it as just gauging if the market's overbought. So if it's trending stronger and you're getting a bearish candlestick signal at the top end of the Bollinger Band, I would still use it. Okay, candles in context. Remember, we're still looking at discipline. We're going through the letters. So we're now looking at C. Candles in context means that we're looking at the candles through the prism of the overall market conditions. So, case in point. Morning star. Now, look at the candles through the overall market conditions, which means risk-reward. If you if you're buying on this morning star, what's your potential resistance area? And I'll give you a hint by drawing the line. Now, one thing I may not have pointed out with the change of polarity, it doesn't have to be exactly the same lows. If you have a zone of prior support, like here, that's fine. You can have a zone, prior support, prior resistance. So if you're buying on this morning star, you're buying at a resistance area. Okay, why not sell at this doji? What's that? It's holding a support area. How do we get support? Prior highs, old resistance becomes new support. And this is why you really can't test the candles by themselves. If you tell your computer to sell every time you get a doji, you're going to get a sell signal on this. That should not be the case. Yeah. Okay, and this is what we saw before. Prior resistance becomes a new support area. Okay, and there are a couple of reasons. Well, there's one reason we should know not to sell. Here's a shooting star. Why would we not sell in a shooting star? Obvious reason. What? Old resistance, new support. And another reason, and I wanted to touch on this just very briefly, is the shooting star made a new high close for the move. Correct? See, it made a new high close. Normally, even if there's a bearish candlestick signal, if there's a new high close, I want to see a lower close under that close to confirm a turn. A new high close is pretty important, bearish candlestick signal or not. That's true with the doji also. Okay, we're not going to get that in the FOREX, but in my non-FOREX seminars, if the market's moving up and then you have a doji above that white candle, which you can't have in non-FOREX, right? If the market makes a new high close, I want to see a close under the doji's close to confirm the potential bearish implications. Okay. Now, we saw this before. Anybody remember what this candle line is with a long upper and lower shadow? Remember as if one's hair is on fire? High wave candle, yeah. Here we have a high wave candle. The market's confused. And I had said before, here are a couple of other high wave candles. I'm going to show you a way to let us know which one of these high wave candles is more likely to turn. And what we do is, this is candles in context. Okay, I threw an oscillator on here, and I'm not sure which one this is, but an oscillator. And okay, the market's overbought here, hence vulnerable. Okay, is the market oversold here? Let me see. This might be RSI, because it looks like it's 30 to 70. Do you have it on, what is it? I think it might be RSI. It's not, we know it's not stochastic, it's probably RSI. It is the RSI, definitely. So, is the market overextended with that second high wave candle where I had the word oversold in question mark? Is it overextended on the downside? No. That high wave candle is likely not going to be that important. This other high wave candle, is the market oversold? Yeah. The market is more likely to rally with that. And then I don't know if it's quite a bullish engulfing pattern after. But this is one very easy way to do it. If you use oscillators, throw your oscillator on, see if the market's overbought or oversold, and then see if you get a candlestick signal confirming it. Okay. One way that the Japanese, and this works really well in the FOREX markets, one way that the market can be viewed as overbought and oversold is by looking at record sessions. A record session is when record session high is when the market makes a higher high. And we're looking at the top of the upper shadow. So first, the market has to make a new low for the move. And then every time it makes a higher high, not the real body, but the shadow, the top of the upper shadow, every time it makes a higher high, we count that as record session 1, 2. Now you see between 2 and 3, it didn't make a higher high. So it's not record session 3. And you go on. And generally between 8 and 10 record session highs, the Japanese will say the market's overextended. You'd view that as overbought. And that works pretty well anywhere from 7 to 12 in the FOREX. A lot of the FOREX markets, it works pretty well. So you could view this as gauging if the market's overbought or oversold. So let me show you an example of this. And this works with record session lows also. Okay, we're going back to slide 152. Show you something interesting. So the market made a high here, and then you start counting lower lows. So this is a lower low. That's 1, 2, 3, 4, 5, 6. All right, so we have 7 lower lows. It's getting pretty close to 8. So the market's getting a little overextended. Okay, that'd be 8 record session lows. But let me go through the count. What's that? The next one was 8. Oh, 8. Okay, 8. Okay, so she was saying, good point. The next one was 8. I didn't even see that. So let's look at an example here. First, we have to find the low for the move. You don't know it's a low until the market starts rallying. Then you look at the higher high. That's 1, 2. You'd see between 1 and 2 why it wasn't 2. The market didn't make a higher high. Now, I have not tried this for intraday. I've done this on daily and weekly. Okay, so for those who trade intraday, I haven't tried this yet. So some of you may want to experiment. And here we have 9 record session highs. Now, all the record session highs do is set up an alert. We need to wait for bearish candlestick signal to really turn negative on this. This is telling us the market's overbought. Remember, like an oscillator tells us the market's overbought? But the real turning signal comes only with confirmation of the candles. So what came after candle session, record session 9? The black candle wrapping around like 100 white candles? Right, the bearish engulfing pattern, which became a resistance area. Okay, so here are some record sessions, again, for you to take a look at. You could say record session 10 on the downside. After 8, we had a hammer, so you start thinking maybe it's a bottom reversal. Now, the reason I wanted to show you this slide is to bring out an important aspect about the record sessions. There cannot be more than 4 or 5 lateral candles, because what's going to happen is, let's say during the advance in these red numbers, like say between 5 and 6, the market trades sideways for like 4 or 5 sessions. Isn't that relieving the overbought condition? Right? By trading sideways, the market's not overbought anymore, so you have to start the count all over again. So let me show you a case in point. So record session 9. What would get us nervous about record session 9 in the red? What candlestick signal? Dark cloud cover. Yep. All right. So you say we have a dark cloud cover and an overbought market. So let's look. See, we're starting the count all over again. The high of the dark cloud cover made a pivot high. We start making lows 1, 2, 3, and see what happened here? It trades sideways. If the market makes a new low after that, you don't say it's record session low 4. You start the count all over again. So what you have to do here, and it shows here, hasn't made a lower low. So what you have to do is start the count over again.
Steve,
yes?
1, 5, and 6, why is it a repetition high?
Okay, which one between? Oh, it should be. It should be. Okay, the question is between 5 and 6. It should be. I just didn't put it right. So it's actually 10 record session highs. And I wanted to see if anybody would catch that, so I did this on purpose. Yeah, right. You believe it. Yeah, yeah. And once again, when there's about 4 sessions or so, we start the count all over again. Okay, we're going to look now at intraday candles. And one thing that was mentioned before is that we have to be more flexible with intraday. And this is true with non-FOREX, obviously, as well as FOREX, is because the opening and closing on an intraday chart within the same day are almost always going to be the same. So this could be a FOREX market, a stock market, it doesn't matter. If the opening and closing are the same, I would view this as a bearish candlestick signal, as a bearish engulfing pattern. Now this is for intraday traders, which is probably about half of you. What I strongly suggest is looking at the daily charts. I know you quiver when I say that. Look at the daily charts and use that as use the support and resistance areas, the important support and resistance areas on the daily chart, and throw them onto an intraday chart. And if you get a candlestick signal in your intraday time frame confirming the support area set by the daily chart, pull the trigger. And let me show a case in point. Okay, and don't worry about the text up there. Essentially what we're saying here, this is a daily chart, and on February 27th, the market is pulling back to a support level. Now what we're going to do is, and look how the market rallied after the 27th. What we're going to do is look at February 27th on an intraday chart. But what I've done is take that red line from the support area by the two bullish engulfing patterns, essentially. I'm going to throw that red line at 137.07 onto an intraday chart, which I did here. And right near that support area, the market formed a piercing pattern. This is a very valuable way of increasing the odds of a trade working on an intraday chart, because support and resistance on an intraday basis is not nearly as important as support and resistance on a daily chart. Many, many more people looking at daily charts. So I threw the daily support area onto the intraday and then used the intraday time frame to initiate the trade. This would have been a great risk reward, by the way. I don't see any resistance at all until those highs. Once again, it doesn't mean you stay fully long. Nothing wrong with taking profits. Okay, the question is, isn't the intraday a magnification of the daily? And the answer is no. Intraday, you may get different signals. And I'm going to show you an example of this in a couple of minutes. Yes?
I noticed you used your target based on the intraday chart.
Okay, good point. If whatever time frame you're looking at to initiate the trade, in other words, whatever chart you're looking at, that should be the chart you're using to get your target. Okay? So if you're pulling the trigger, see what we're doing is using the daily chart to get support, but we're actually pulling the trigger, initiating the trade based on an intraday candlestick signal. You should be setting your target based on that intraday chart. Yes?
When you're looking at the daily chart, what time frame are you using for the daily chart? A month? 6 months?
Okay, the question is, what time frame am I looking for the daily chart? My default is normally 2 or 3 months, but I will go back as far as necessary to find the first support area. But my normal daily chart is 2 or 3 months. 3 months usually. Okay, because that's a nice, that usually gives us enough time or enough data to find lots of support and resistance, and also the candlestick signals are easy to read. Okay, here we have a very obvious support zone on the daily chart, okay, shown by the two red lines. Now, yes, it closes a hammer, but we're an intraday trader. We don't look at a hammer on an intraday chart. What we're going to do is we're going to throw, what date is this? On June 5th. Okay. We're going to throw this red horizontal support line onto our intraday chart on June 5th. And that's the support zone from the daily chart. And on June 5th, this is a 30-minute chart. See what we got? A morning star. What would be my target? It would be based on the intraday chart. I'm not using my target based on the high back here at 123. That's not my first target. My target, because I did the trade on the intraday, is the intraday target. Okay? And that could be a potential target. That looks like an okay risk reward. You know, we have to make sure, we'd have to actually measure, but it looks like more than 2 to 1. Okay, support and resistance from the daily chart. We have old support becoming resistance, those blue lines. And what I've done is we've thrown that resistance area onto the intraday chart. So this resistance looks like around 126.60 in that area, 126.80. Okay, so I threw that onto the intraday. And Right, that resistance zone is just based on the daily, and look at the signals we had on the intraday. Now, in spite of these signals, the first semicircle is a bearish engulfing pattern. The second semicircle is what? An evening star. It's also a bearish engulfing pattern, right? Too. But would we sell short on that? Think about the risk reward. We're getting lots of bearish candlestick signals at an important resistance. They're important because it's a daily chart. But think about this. If you're selling on that evening star, aren't we selling at support? Right? So I'd wait for a break of the support area. But the point is you had a group of candlestick signals on the intraday chart confirming a support area, a resistance area on the daily chart. It's a really useful, quick. I'm sorry, what's that?
You're going to buy
No, I wouldn't. The question is, would I buy in that long black candle? I'd sell on a close under the bottom end of that trading range, on that, probably on the long black candle. I would, right. As soon as it broke under that support area, I wouldn't even have to wait for the close. Okay, and these are some potential targets. Once again, because we're using an intraday chart to initiate the trade, we're using the intraday chart to get our targets. These are just prior support areas, essentially. If you trade intraday, you always have to monitor the daily charts. What I would suggest, how many use two screens, 2 or 3 screens here? Okay, who doesn't? Okay, you have to have 2 or 3 screens. You have to have different time frames. At a minimum, you have to have a daily chart, and let me show you why, even if you trade intraday. Here we have the change of polarity, old resistance becoming support, and notice how the market stalled at that red line there. The reason the market stalled there, this is an intraday chart, is because the market had very important resistance. Okay, this is 129.70. This is June 5th. Okay. This is June 5th on the daily chart. And obviously, during the session intraday, we don't know what's going to form a shooting star at the end of the day. But why do you think the market stalled there during the day on June 5th? Look at the resistance, a bearish engulfing pattern. Even if there wasn't a bearish engulfing pattern, that's an important resistance area. We always have to be alerted to where support resistance is on the daily chart. Now, this is for swing traders, for those who normally don't use intraday charts. You can use intraday candlestick charts to really improve your timing. Quick question, yes?
What time frames do you consider intraday on this daily intraday mix?
Well, I'm sorry, what's the question?
What time frame do you like to look at?
Oh, for intraday, I look at the charts at the end of the day. So I'll look at 30, 60 minutes daily charts, sometimes a 15-minute. But if you have access, if you're looking at intraday charts, if you're an intraday trader, it all depends on your holding period. Okay, if you're in the trade for a couple of hours, I would use a 15-minute, maybe a 30-minute, 5-minute maybe. But I would not suggest using 5 or 15-minute candlestick signals or even 30-minute candlestick signals in and of themselves to buy or sell unless it confirms an important support area. And that, to me, is on the daily chart. Okay. So for swing traders, okay, how do we improve trading or timing with an intraday? Okay, we saw this before, this slide before. I just kind of blew it up. Okay, the red arrow points to a hammer. Okay, when did we get the hammer's confirmation? Remember, for a candlestick signal, we need the open, high, low, and close, right? So for those who use a daily chart, you have to wait for the close of a daily chart. But there's nothing to say that you can't use the close of an intraday chart. So this would not give us a good risk reward because our entry point is here on the close or the next day's opening. So this would not be a good risk reward. Okay. So this price area here is right around 174 on the close. April 3rd, I'm making a magnifying glass, zooming in. This is April 3rd. This is a 60-minute chart. Okay. What's happening on the 60-minute chart? Some long lower shadows, right? Not really enough of a buy signal, no hammers, but nonetheless we're getting some lower shadows. Okay, and that is right around the 172.50 area. Okay. Now let's look at a 30-minute chart. April 3rd, morning star, piercing pattern. Okay. Bullish engulfing pattern. So essentially, we had a group, and the market's going from lower lows to the same lows. So essentially, we were getting reversal signals right around the 172.70 area. Even if you waited for a close above that little resistance area, you see those 3 or 4 or 5 sessions, you see a little resistance there with the engulfing pattern and all that. Even if you waited for a close, it would have been a little above 174. So essentially, by using the intraday charts, instead of just the daily charts, this is where you would have gotten the buy signal on the daily chart, which means you wouldn't have bought it because it's not a good risk reward. Okay. By using the intraday chart, your intraday buy would have been down there, which is probably at least 100 basis points lower. Now, because you're trading with the daily chart, your target is the daily chart. So what you've done is you've found a hidden support area you would not have seen on this daily chart by going intraday. Let me show you an example again. This is the daily chart. Right. The target is whatever time frame you're using to initiate the trade, that is the time frame you should be used to set your targets. If you're trading with the daily chart, even if you're using an intraday, to get early reversal signals, if you're your daily chart, I would be looking at that. So here, the market closes at what do we have here? Bearish engulfing pattern, right? Now, it closes here on April 6th at 122.29. Is this worth a short? And again, because a price target is subjective, I'll show you what I'd be using. I'd just be using the pivot low there. So essentially, the stop would be there, and the pivot low would be a potential support area. So the risk reward, not very good. Now, let's go to an intraday. Okay, here we have a 60-minute chart. So this is April 6th also. Okay, that black candle was April 6th. So to your right with the light blue shading, that's April 6th. On the 60-minute chart, see the reversal signals we got? The doji. Okay, and even if you wanted a little extra confirmation, okay, you may have waited for the close into the doji there. Okay, be a bearish engulfing pattern. Remember, if a black candle wraps around a doji, it's still a bearish engulfing pattern. So essentially, you would have gotten a sell signal at 123.05, okay, instead of 122.29 on the daily chart. So you would have gotten an earlier sell signal. As I mentioned before, if you're trading on the daily and using the intraday to get an earlier signal, your target normally should be based on the daily chart. But if you happen to be home and you see this and you're trading here, and on the intraday chart you see the markets tending to build some long lower shadows, like on the right side there, some piercing patterns, nothing wrong with taking some profits. Okay, swing traders. Using an intraday chart to see if the market is holding support or resistance. Okay. Here, a daily chart. Now, we have the support area shown by the 2 red lines. On May 17th, that was pretty close. Was that a successful test of the lows made with those red lines? And what we could do is go to an intraday chart to see what kind of signals we got on May 17th to see if indeed that was an important confirmation. So here's May 17th. This is a 60-minute candlestick chart on May 17th. What do we have in the red square? A bullish engulfing pattern, a morning star. Same thing, same date on May 17th on the 30-minute. This, by the way, I didn't mention this. This is a variation on the morning star. You could have more than one small real body between the black and white real body. And this is a 15-minute. Same thing. So 3 different time frames. We're going to be looking at using multiple time frames intraday in a couple of minutes. But 3 different time frames saying, okay, the market definitely, although on the daily chart, you really can't see if that was a really important test of support. But looking at these intraday charts, you say, definitely, that was a successful test of support. Now, this is good for both intraday and swing traders. Swing trading. Use multiple time frames. It doesn't happen that often, but if you get multiple time frames, intraday time frames, like we saw before, showing a bottom or a top, I would be all over the trade. So here, on this daily chart, we had a morning star was confirmed at 125.93, and on July 19th, we're going to go to an intraday and show you what we had on the intraday. So this was confirmed. Let's round it off at around 126. Okay, look at the intraday here. Okay, on the 15-minute, at around 125, just rounding it off, that is a hammer. That lower shadow is twice the height of the real body. Okay. What do we have there on the 30-minute? Again, on July 19th, in the red rectangle, morning star. Okay. Okay, that morning star was completed at 124.88. Okay, now remember, on the daily chart, the morning star was completed around 126. So you're looking at reversal signals over 100 basis points earlier than you would have gotten on the daily chart. And then on the 60, yeah. On the 60-minute, what do we have? A piercing pattern. When you get signals like this, and normally I won't go less than 15 minutes, if you get a 15 to 30 and a 60-minute, all giving you various candlestick signals, this is a very high probability trade. So, and here it was completed at 124.88. So essentially you had 3 different time frames confirming a potential bottom almost 100 basis points before you would have gotten it on the daily chart. Never trade without knowing about the news. And the reason for this is if there's an important number coming out, stand aside. Okay. Obviously, there are going to be times where a surprise news item comes out and the surprise news item can overwhelm the technicals. There's no doubt about it. I'm not enough of a pure technical analyst to say all the news is discounted. I don't believe that. If you get a surprise news item, the market could blow through support or resistance. The Japanese say that just because the water's calm, don't think there aren't any crocodiles. You could have all the technicals lined up and a surprise item comes out, you have no control. But if you know a balance of payments coming out, an unemployment number is coming out, why take a trade in front of it? It's a coin flip. So, for example, here, the water looks fine. Speaking of the crocodiles, I would be perfectly comfortable selling short here, the doji, confirming resistance, and then the market pushes above it. I don't remember what the news was, but this is what's going to happen. This can happen, and we have no control over this. Okay. L. Okay, we're still looking at the word discipline. Let go of emotions. Okay. Psychology. Okay. It's human nature, first of all, not to accept losses. That's why I suggest putting stops in at the beginning. And this is why, how many of you have trading journals? Everybody should be using a trading journal. All right. The reason for doing the trade, the stop out level, the risk, what happened, lessons learned, and that's a great way of helping you get very, very objective about the market. Very important to have a trading journal. Lessons learned and so forth. Now, the challenge we have is what in psychology is called anchoring to a position, okay, or anchoring to an opinion. So in the markets, what this would mean, if we're bullish, we tend to focus on the bullish news and downplay the bearish news because we want our opinion to be confirmed. On the flip side, if we're in a short position, we're going to feel like this. We can't do that. We have to, and this is what the candles are really good at. By using the candlesticks correctly, it'll really help foster an objective view about the market. Many of my institutional clients know the candles inside out. The reason they use our service, I don't want to know their positions. They get completely objective advice from us, and they like it. That's that outside voice. So here the market is moving down. If we're short and we were emotional about this or anchoring to a position, we'd say to ourselves, hey, I'm short, and the market's making lower lows and lower highs and lower closes. You know, I'm cool, right? I'm right. I'm never wrong. But really, if we analyze the candlestick signals, what are these candlestick signals showing us? This is the pound yen. What is it showing this in the pound? Right. As it's moving down, even if you didn't remember the hammers, those long lower shadows, right? You should really be saying to yourselves, yes, the market's ascending and I'm short, but these long lower shadows are showing me I should scale back a little bit. If you can, stand aside or step back from the market. Ideally, one should be also able, depending on what the market circumstances are, to go from I love the market to I hate the market. Most of us are not going to be able to do it, but here's the case in point. See how the market tested support and the red lines there? Okay. And you might say you like the market every time it tested the support, but as soon as the market broke the support level, old support should become new resistance. You really have to say the market is telling me something different now. I don't like the market anymore. Many of us are not going to be able to go from long to short, okay? But to be truly objective about the market, to step away from the emotions, you have to say, okay, I may have liked the market before while it held support, but I don't like the market now because the market told me it failed to hold the support area. We're not smarter than the market. We're always picking up those little clues the market is giving us. Pace the trades according to the market environment. Okay? That means that we should be looking at what I call being a market chameleon, just changing our stance according to what the market is doing. Each session, the market is giving us new information. And to be a really good trader, we have to always assess what the market is telling us. The market today is not the same as the market yesterday. So this was a chart we had seen before. Remember, with the surprise news item, we would have been negative on the doji, but the market pushed above it. Okay? But now we have new information. The market had a resistance area. So although the surprise news item really pushed the market higher, we're now analyzing the market in the condition of the new environment. What's going to happen now if the market's good? Old resistance should become a support level. Because the market's changed. With those doji, the outlook was negative. The market pushed above the doji. It's telling us that our outlook should adapt to it. And because it was a prior resistance area, old resistance should be new support. Okay. Adapting to the market. And this section has to do with using maybe adjusting stops or taking some profits. So here, okay, what pattern is this? Quick. Okay, this is a piercing pattern. A bullish engulfing pattern would be if the white candle wraps around the black candle. Almost a bullish engulfing pattern, but not quite. Okay, what's first support on this? Where's the support level on the piercing pattern? And give me a number. Low. It looks like 119. Okay, 119. All right. So based on this, what's happening today, my support area would be 119. No problems with that. Now, time moves on. This is that piercing pattern in the green semicircle. Is first support something different now? Okay. How about over there? Because the market is telling us, yes, we still have support near 119, maybe 119 and a quarter, but now first support is 120. Could we have known that on the piercing pattern? No, because we did not have the new action. The unfolding action. So now we say to ourselves, okay, there's a potential support area at 120, and maybe the market won't pull back to the piercing pattern. Okay, maybe the 120 area would be a better buy. So we have a support area. Remember the candlestick screener. Is the market at support or resistance? Is that support? On the blue double lines there, right? But the second aspect with the screener, are there any signs, the prior trend, in this case down, are there any signs the market's losing steam? No, so I would not be buying here. How about here? Yes. So this is what I mean by adapting to the new market circumstances. Initially, our support area was the piercing pattern, but because the market told us for whatever reason, instead of 119 being support, the dollar, this is dollar Swissy, the dollar had support around 120. That becomes a potential support area. Okay. And perfectly fine target. This would have been a great risk reward. But if you were waiting for a pullback to the low of the piercing pattern, it wouldn't have happened. And you had plenty of clues to see that. Same thing here. Okay, negative divergence here. Okay, the market made the same highs. And if we sold here, what would our potential target be? Maybe, okay. By the way, this is what I would have is S1, minor support, only because it's the lows on a couple of sessions. Our more important support area would be S2 with an asterisk. Okay, because look at all the resistance there. All right. Now, the market is pulling back. So initially, if we sell there, the first support is S1. We're not viewing it as major support. But look what happens now. This is S1. Do we increase the importance of that support area now? Yes. Right. Because the market is telling us, especially through a hammer, that that is becoming an important support area. And look how well it held there. So we're always adapting. We're always changing. Same thing here. Let's say we short here. Where's our target? Yeah, 190. I mean, you could be looking at the piercing pattern, but even that low there, the low of the long lower shadow, maybe around 120.25. That would be minor support to me, but certainly the piercing pattern. So let's say the piercing pattern is your target because it's an important support area, potentially important support. So you short there, really good risk reward. Okay, the market, and that's a stop out level. Remember, we always have to define our stop and the target. And this is a minimum target, but we may be looking at the piercing pattern as more important. Now, let's say this is our target. Anything happening here? This happens to be a daily chart. It doesn't matter. Anything happening here to change our outlook about the target being reached? Session after session after session, we have support around 120.75. Move stops. Take profits. Right? You see something like this. The market is always changing. Okay? And this is what happened after. So this is what I mean by pace ourselves according to the market environment. So what we've done today, look at a couple more charts, is look at ways of getting early reversals. And it's more than that. We've also seen ways to achieve peak trading performance. How? By viewing the information in the candlestick lines. And one of the very important aspects is not only getting those early reversal signals, but avoiding the bad trades. Okay? Warren Buffett had a couple of quotes. He said, 2 rules. Rule 1, don't lose money. Rule 2, don't forget rule 1. You know, one of the best ways to make money, don't lose money. And by correctly using the candles, you'll know which trades to avoid. Not only which trades to get in, but which trades to avoid. Very, very important. One trader who said to another trader who was on a losing streak, he said, you know there's money in the market? And the other trader said, yeah, it's mine. Don't let it be yours. But the real asset of the candles is you're going to be able to pinpoint the Forex turning signals with razor-sharp accuracy. Western technicals are great for that confirmation, but you're going to find most of the time the candles are going to give you early reversals much earlier than the Western signals. You're going to get a jump on the competition. So for example, here, for those who use the, I think this is the MACD. Let's see what this is. Yeah, this is the MACD. Negative crossover, and the blue and the red and the green circles show where the crossovers are. So we had a bearish crossover in the red ellipse and a bullish crossover in the green, but very typical. Evening star here, a morning star here. This is what's going to happen very, very often. You're going to get the early turns with the candlestick signals. If you want a little extra confirmation, you want to wait some extra days or sessions, you could use the oscillator. But very often, you're going to get the early clues with the candles. This is what they really shine out. This is why the institutional traders use them all the time. This is why people who know about the candles and use them correctly, people who don't use them correctly just get totally screwed up with the candles. Okay, here we have an inverted head and shoulders When is an inverted head and shoulders confirmed? The neckline. So we got the confirmation by the close under the neckline. Anybody see anything under the lows of the head? Any candlestick reversal signals? A hammer and a bullish engulfing pattern. And look at the potential turning signals. Look how much earlier we got it. And yet you could use the inverted head and shoulders to get a potential price target. But the candles are what it's all about, those early reversal signals. Who here would ever trade with a bar chart again, right? I mean, nobody here has traded with a bar chart again, but as I mentioned before, if you're trading with a bar chart, you're really trading at a financial disadvantage. And once again, I have to remind you, the candlesticks are a tool. They're not a system. They have to be part of what I call my trading triad success model. The triad is comprised of 3 components, and we focused on 2 of them today, really. Candlestick charting techniques, Western charting techniques, and the third leg is money management. We touched a little bit more on, we touched on money management. That's more in my advanced material. But the idea of the trading triad is that it's a really unique synergistic approach to trading that's custom designed to let you enter and exit the market with better timing and at the same time letting you decrease risk. We really need all 3 of these. And I like to compare the triad, the trading triad, the 3-legged approach to trading to like the construction of the samurai sword. The blacksmith who made the samurai sword would take iron, place it into a furnace until it was white hot, almost translucent, and he would take it out, and then while the iron was still malleable, he would put it on the anvil, and with a heavy hammer would pound it into the desired shape. And once the desired shape was reached, he would take the iron, plunge it into a bucket of water, and that extreme change in temperature would give the iron, which would ultimately wind up as a sword, its durability and strength. And the 3 tools of heat, hammer, and water together made a weapon that could not be made any other way. And so it is with the trading triad. The candlestick charts, the early reversal signals. As one person who attended my seminar phrased it, he came up to the seminar after me, actually a few days after when he started to really trade with this. I said, this is great. I can get into the market before the market does its thing. I said, that's a great way of putting it. That's what candles are all about. Candlestick charts. Western technicals, like the anvil. We need all 3 for those confirmations. We get a candlestick signal confirming a Western signal. Also, we need Western technicals for price target. And then money management. Okay? The samurai would say, weigh the situation and then move. How do we weigh the situation? By looking at money management, risk reward, adapting to the market, some of the things we talked about today, candles and context. And these 3 weapons, the candlesticks and the Western technicals and money managements forged together will be like your weapon in your battle of trading, because trading is almost like going into battle, will be your weapon in your battle, both offensive and defensive weapon in your battle for Forex trading. So I want to thank you. You've been a great group. And I know it's been a long day, but we'll stay around for any questions. And what we'll do, thank you very much.